From boardrooms to work floor, sales to operations, origination to servicing and internal events to industry conferences, AI and automation is virtually in every conversation we're having in the mortgage industry. How will AI and automation disrupt our industry? Or will it be just another tool that lenders could decide to use or not use? Hi, I'm Rajeev Kumar, your host in this inaugural episode of Tech in Mortgage. I have a distinguished guest today, James Deitch, who will share with us where our industry is headed with regards to technology and AI. Jim is an entrepreneur, author, and industry thought leader who frequently speaks at industry conferences. Jim, welcome to the show.
Rajeev, hey, it's great to be with you. Thank you so much to have the privilege and honor to be on your first podcast.
Well, I'm glad to have you. I'm glad to have you. So as we start talking about this more, can we just do a quick intro on Terra Verde?
Actually, I'd rather just talk about the issues.
Okay, that's awesome.
Awesome,
That is
yeah.
awesome. So let's start with what are the most, like the three top most pressing issues that you think we have in our industry today?
That's a great question. And I think there's three items that come to mind. The first is the cost to produce a loan. It has just been increasing from $2,000, $3,000, $5,000, $12,000. It's just crazy how much it costs. And that has an impact on the second issue, which is housing affordability. It's housing prices, it's interest rates, and it's the cost to produce a loan. And then lastly, it's the customer experience in buying and financing a home. Those issues, I think, are ones that the industry has to solve to return to the prosperity that awaits all of us when we adapt.
Well, when we adapt, that was how you ended that. So what are you seeing from an adaption perspective? What have you seen work and not work, and why are we not adapting?
You know, Rajeev, that's a great question. There is so much great technology out there. One can do incredible things with technology in the mortgage industry. When I think of parallel industries like the airlines that fly, think of taking roughly 75,000 takeoffs and landings a day without incident for the most part, in all kinds of weather, with all kinds of different equipment, with people all going through the sky. And taking an aircraft off is not that difficult. Landing it and not breaking it is difficult. And all the technology that augments what the pilots and the air traffic controllers do to make that work largely comes by broad adoption of the tools and automation that make the airline industry as safe as it is. Not necessarily the case in the mortgage industry.
That is so true. And I've seen some examples of great technology being wasted because of user behavior or whatever, existing workflow issues and so on. And I've also seen examples where the technology, unfortunately, wasn't necessarily built the right way, considering everything that goes on in our industry. What are you seeing from your perspective? Is it primarily on the user side? Is it technology? Is it both, or something else?
So I'm going to answer your question with a question. We surveyed at two large conferences of LOS providers, the participants, and we asked them, what percentage of the native automation that's already in your LOS are you actually using? And this was, one of those fill out the, click the paddles, et cetera.
Right.
So what do you think the average number that came from the executives answering that question was?
I know, I would guess 50%.
It was 22%.
Wow.
And the question I asked the audience was, so let me get this straight. We're all saying that we're using 22 to 25% of the built-in automation, but you're paying for 100% of it. Does that bother you? And the answer is yes. And the next question I asked is, if you took all the data that currently spins in your systems, you have the data right now, and you applied it effectively, how much more per loan would you earn? And I'll just ask you the question, was it more or less than $1,000?
I would guess, I'd guess less than $1,000.
Okay, if you had a second choice,
That's obvious. All right.
more than
Okay.
$1,000, right?
Yeah. Yeah.
More than
Yeah.
$2,000. Yes or no?
Wow. I can't think of that. I mean, I would say more than $1,000 now that you've given me second choice, but more than 2,000? No, I can't think of that.
Yeah, it was $2,100. So the second question I asked our audience was, if you know that you could make $2,100 more per loan simply by using all the data that you have in your systems, what's holding you back? And a lot of heads went down, a lot of, shuffling, pulling out the phone, thinking about stuff. But I did get to talk to people one-on-one afterwards. And what do you think their answers were? Why wouldn't you do this? You already know it's not happening. You already know the potential upside is there. Why wouldn't you do it?
People afraid of their positions or whatever they're doing, not, need for their departments and things of that. I mean, that would be my guess.
It's exactly right. It's not the technology doesn't work or it's too expensive. It's inertia. I like doing what I'm doing. It's fear. This may affect my job. It's self-preservation. I could automate myself out of a job. There's nothing in it for them. There's a parent. All these different emotions hold people back from adopting the very thing that would create less fear, more opportunity to stay at a winning lender, more opportunity for advancement. But fear is such a tough emotion that if you don't overcome it, you won't get adoption. If you don't get adoption, this will be just another failed shiny object that ends up in the dustbin that people complain, I spent all this money and it doesn't work. It's a self-inflicted wound. So what's the remedy? What's the remedy?
I don't know. I mean, but I do want to echo some of the thoughts that you just had, because I was at the IMB conference in Austin a couple of weeks ago, and they were talking about they had data on technology spends increasing, yet the productivity not increasing, right? And my guess was maybe it's because, people are overstaffed, but perhaps there's something else going on here. I would guess that people are just not adapting it, and it needs rethinking in terms of the way you introduce this or do this. But I'm here to hear your thoughts.
There is one answer to what will cause adoption to occur in a technology project. And I think it's only one answer. You have to have an extremely passionate, committed executive sponsor that says, we are doing this, we're not turning back. He or she will say, charge, 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 be with me or don't be here, because we're going to make this work. When I see that level of executive sponsorship present, projects go really well. And when not, they don't. And I'll give you an example. In one of the books that I wrote, I had a chance to interview somebody that it's probably known to some of the audience. Do you want me to tell you the story?
Yeah, please.
So most people have read the book Moneyball or seen the movie. And if you haven't, it's really how data was used to identify the value of a baseball player by one simple metric. Did they get on base? And there's more to it than that, but did they get on base? And if they got on base, how often? And then how much did it cost for that salary vis-a-vis the number of times on base? So it's a pretty simple thesis. And Billy Beane, who was the executive vice president of the Oakland Athletics, literally pioneered that system, but he found that adoption was a problem. So he told me this story. He says, we had spring training and we went through and we got all these guys coming in from spring training. They think this is their chance to be in the MLB. It's going to be really great. And the one thing we want to see about anybody who's going to play Oakland Athletics baseball is, can they adapt and adopt? So we tell them right away, this is all about pitch count, because if you get ahead of the pitcher and you're one ball, no strikes, your batting average goes up 100 points. If you get behind the pitcher by one strike, no balls, your batting average goes down 100 points. So we have gotten a lot of algorithms here that say, when you're coming up this type of batter against this type of pitcher, I want you to take the first pitch. So go out there and take the first pitch. Now, this is the first day of spring training. The people are there and they got their egos going, and man, I'm a hitter, I'm going to show you. So what's the pitcher do? The pitcher says, make sure, or Billy tells the pitcher, make sure you throw the absolute most hittable ball right down in the sweet spot. And invariably, these guys will hit it. They'll hit it out of the park. They'll go running around the base. They step on home like, look at me, look at my training day. This is fantastic. I'm going to make it on the A's. And they will get their butts ripped with, you do that again. If you do not do what we tell you, take the first pitch. Oh, no, it was a great pitch. Didn't you see me hit it in the park? Take the first pitch. We're playing statistics here. We're not playing your role. We're playing my system.
Wow.
And if not, you're going to ride the pine in Sacramento. And Sacramento was the minor league team. And he said, you would not believe it. 20 people get cut that day because they can't do something simple like take the first pitch. We have a system, we're going to use it. And that's exactly what happens in our industry. People will fight automation. They will fight technology simply because it's emotional. A strong executive leader would say, now, Jim, you're going to go up there and I know you're going to want to hit, but don't. When I tell you to take the first pitch, take it. And if you swing at it, you're cut. Do you understand? That's strong executive sponsorship. And if they swing it and hit it, you say, look, I just want to make it real clear. That was your one mistake. The next mistake, you are history. Now, maybe that's a little harsh, and we're talking about, Major League Baseball that's going to cut 75 people to get down to 25. But that's what we need. People have to say, we're doing it. It doesn't matter what you used to do. I am invested as an executive sponsor in making this happen. And that's how projects get done. Believe it or not, that's how projects get done.
You believe that that's how companies who are, doing it will stay competitive and be around and grow their business. And those who don't, they would have some crisis situation to face. And some of them have already been facing over the last, I'd say about 30 months, right?
It's been a really tough, more than 2 years for the mortgage banking business. And returns on equity, the amount of profitability, we all know that story. But here's the story. Anytime you get the data, the MBA data shows that there are, even in the worst of times, there are 20-25% of the companies that are profitable in origination. And it's because they have the systems and they control their costs. And even now, where it's getting a little bit better and 60-some% are profitable, everybody's touting, hey, it's great. We made 14 basis points. 14 basis points on all the capital spent? Are you kidding me?
Yeah.
Like, you're taking all this risk for 14 bips? So it's just a frame of mind. And the opportunities, I think, are really boundless. And what I think will happen is that you will have this separation of those folks that really understand how to re-engineer their process and get out of the 1939s when Fannie Mae was created, and we're doing a lot of things the same way, believe it or not, and move it to something that's much more scalable and productive. But it's leadership and sponsorship that makes the difference.
So given everything that you know about technology, and you're very close to technology, your company does a lot of work in that area. Given everything that you know about technology and AI, as well as the lender behavior and the executive sponsorship issues, what are some of the top processes within the mortgage back office that you think is absolutely ripe for automation, must be automated?
Well, that's a great question. We've done a fair amount of data analytics on a large number of lenders, and there's a direct correlation with how complete and how well the information from a borrower is gathered first touch or second touch, right? Not the 15th touch, but the first or second touch. And to the extent that you get a well-structured, well-documented file, you end up with a well-structured file, because the originator will know what to do when they find out the person is self-employed, or they have multiple K-1s, or they have cash income, or they barter crypto, or whatever it may be. When you know all that up front, the loans go through and they are easier to do and they get done more quickly. When it's playing the let me ask you one more question 50 times, we know three things. One, you never ask the right question in the right sequence, so it frustrates the borrower. You miss some things that don't come up until the underwriter looks at it and says, well, now wait a minute, what about this? And now you're going back in repair mode. And lastly, customer experience. Customers will give you anything you ask for. The first time, the second time. They might even give you that the third time. But if you go back the 10th time and you're asking for more, it's just going to be an issue. So getting all that up front, whether it's direct source data, whether it's third-party source data, or whether it's data coming from the customer that can quickly be synthesized and extracted, classified, and verified, that's what you have in companies that tend to be very profitable. And they may not even use technology. They may just have a very well-trained sales force. But it's getting the right information up front. And if you use technology, then you can really work on the cost. But it again comes to leadership. And loan application, the more full it's taken, and the more good information you have, you get the structure right, and it flows through smoothly without surprises. And that is the key. If someone had a magic vacuum cleaner to suck up all the information that you wanted to have and put it in there and extract it and classify it and put it in the right place, and then say, hey, we're missing A, B, and C. You got A, B, and C. You said, we're done. You're approved. If you could do that in 24 hours, you would own the world, in my view.
So, of course, we, came up with a POS system several years ago, and that was supposed to solve for a lot of those issues. Clearly, it hasn't. So sounds like what you're saying from a technology perspective, you still need something that's behind the scene of perhaps the POS and LOS, kind of recognizing all the documents that are coming in, being able to really synthesize that to say, yes, it is good to go. Yes, it's not good to go. And try to do that as early as possible in the process and give that great borrower experience.
I think that is a key element. It's also training. It's also sponsorship that says, this is how we do this at our lender. We don't not use the technology. We don't go off and, kind of move around and run AUS 75 times to see what works. We have a structure and a process. And whether it's the Oakland Athletics that say, we have a structure, we have a data-driven system of how we're going to make sure that we get the best opportunity to get on base, and we pay the least amount to the players to do that. And by the way, I know the last couple of years for the Athletics have been challenging, but from the 20 years from 2002 to 2021, pre-COVID, literally the Athletics always finished great, and they have one of the lowest cost per wins in the industry. Not always, but most of the time, which means the system does work. I asked Billy, why does it work? Everybody knows what you're doing. And you know what his answer was? Discipline, executive sponsorship. If you don't have discipline to believe in the system and realize it's a system, some years it'll work great, some years it won't work so great because of statistical variation, but it will work. And you have a leader that says, I'm willing to accept that there is going to be some variation and there will be some blowback, but in the end, we're going to get there. That's what made it. That's what made it work. And that's the key in my mind to literally anything in business, literally anything at all. It's belief and sponsorship from the leader that says, I believe in it and we are going to do it, and it's not optional.
That's awesome. That's awesome. Well, we could go on and talk more about it, but I believe the key takeaways for me from everything that I've heard so far, you have to have the right executive sponsorship. You have to believe in the system. You have to keep at it for a while, having the right people around who can carry on the system and work with it. And everybody must watch that Moneyball movie, I guess.
It's got a lot of business lessons. Every time
Absolutely.
I see it, I get one or two other lessons.
I watched it 2 years ago on your recommendation, and what a time well worth spent. So I do recommend that to everybody watching this podcast. But Jim, it's been a pleasure having you on the show. Thank you very, very much. And I look forward to talking to you again soon.
Rajeev, appreciate it so much. Best of luck. Thanks.
Thank you.